Build your dreams, live rich, and leave rich.
Welcome to Live Rich and Leave Rich. For me, the philosophy is pretty simple. To live rich isn't about being lavish. It's about living peacefully because you have financial clarity. And to leave rich, well, that's about passing on wisdom, not just your wealth. Now, before we get into it, just the mandatory disclaimer. This is all for educational purposes. Please always consult a SEBI-registered financial advisor before you make any decisions with your money. You know that feeling, right? You walk into a bank, or maybe you open one of those investment apps, and suddenly you feel completely lost. It's like everyone around you is speaking a language that you were just never taught. If that sounds familiar, trust me, you are not alone. It's an incredibly common feeling.
So you hear a sentence like this one, just packed with acronyms, and your brain just kind of freezes. You might start thinking, am I just not smart enough for this? You might even just nod your head, sign whatever's in front of you, and get out of there just to make it stop. But listen, let me tell you a little secret. They are not smarter than you. They just speak a different language. And honestly, it's a language that's almost designed to be confusing.
Well, today, that all changes. I'm going to teach you the ABC of money. And by the end of this explainer, you're going to be able to decode over 30 of the most common financial terms, from NIFTY all the way to XIRR, and you will never, ever feel confused in a financial conversation again. This is about you finally owning that conversation. Now look, if I just started listing out 30-plus acronyms, you'd be bored out of your mind and you wouldn't remember a thing. So we're not going to do that. Instead, we're going to use a really simple, structured framework. We're going to sort all of these confusing terms into 6 very logical buckets. This way, it'll be so much easier to understand, to remember, and most importantly, to actually use this knowledge in the real world. All right, let's dive in. Our very first bucket is what I call the markets dashboard. I want you to think of these terms like the gauges and dials in your car, right? They don't actually drive the car for you, but they tell you exactly how fast you're going, if you've got enough fuel, and if everything's running the way it should be. These terms give us that quick snapshot of the market's overall health. Okay, so the 2 biggest dials on that dashboard are NIFTY and SENSEX. The simplest way to think of them is like the market's thermometers. The Nifty 50, it just tracks how the top 50 biggest companies on the National Stock Exchange are doing. And the SENSEX, same thing, but for the top 30 on the Bombay Stock Exchange. So when you hear on the news, the market is up, it just means the value of these big companies, and therefore the NIFTY or SENSEX went up. That's really all there is to it. So, how do you actually invest in the whole market, in all those companies at once? Well, 2 of the most popular ways are with index funds and ETFs. An index fund is like buying a pre-made shopping basket that already has all the Nifty 50 stocks in it. You buy 1 unit and boom, you own a tiny piece of all 50 companies. An ETF, or an exchange-traded fund, is a very similar basket. The main difference is you can buy and sell an ETF instantly, right on the stock market, just like you would a single stock, anytime the market is open. What if you want to invest in big properties, but you don't have crores lying around to buy an office building? That's where REITs come in. A REIT, or a real estate investment trust, is basically a mutual fund for real estate. It pools money from tons of investors, like you and me, to buy and manage big properties that generate rent. Think office parks or shopping malls. You just buy units of the REITs and you get to earn rental income and watch the property value grow, all without the headaches of being a landlord. Okay, so we know how to read the dashboard. We know what's going on in the market, but how do we actually get our car on the road? That brings us to our second bucket, your investing toolkit. Think of these as the different vehicles you can choose from to get to your financial destination, and knowing which vehicle to pick for which journey, that's absolutely crucial. The most famous tool in the kit is, of course, the SIP, the Systematic Investment Plan. I call this the good habit of investing. It's simple. You set it up so a fixed amount, say 5,000 rupees, automatically gets invested from your bank account into a mutual fund every single month. By the way, a lot of people do their SIPs in special tax saving funds called ELSS, Equity-Linked Savings Schemes, to get a tax deduction. But the real magic of a SIP is something called rupee cost averaging. When the market is high, your 5,000 buys fewer units. When the market is low, that same 5,000 buys more units. Over time, this just averages out your cost and smooths out the ride. Now let's fast forward. What happens when you've reached your destination, you're retired, and you need to start living off your investments? That is where the SWP comes into play. A systematic withdrawal plan is the perfect opposite of an SIP. Instead of putting money in every month, You automatically sell a certain amount of your mutual fund units to create a steady monthly paycheck for yourself. It's a brilliant way to create your own pension, and it works great alongside government plans like the NPS or National Pension System.
Now, a quick but very important word of caution. You're going to hear people talk about ULIPs, or unit-linked insurance plans. Please be very, very careful. I call these the trap, and for good reason. They try to mix insurance and investing into one single product. And the problem is, they usually do both jobs really poorly. They charge incredibly high fees that just eat up your returns while giving you pretty lousy insurance coverage. It is almost always a better idea to keep your insurance and your investments completely separate.
All right, so you've picked your vehicle from the toolkit. You've started your journey. But are you actually making progress? How do you know if you're even moving forward? To answer that, we need our third bucket, grading your investments. This is where we learn to read our own financial report card and figure out if we've actually made any money.
Let's start with two of the most confusing but most important terms out there, CAGR and XIRR. Now, CAGR, the compounded annual growth rate, tells you your average yearly return. It's perfect if you invested one big chunk of money all at once, what we call a lump sum. But for your SIBs, where you're putting money in every single month, CAGR can be really misleading. For that, you need XIR, the Extended Internal Rate of Return. XIR is the real return because it's smart enough to factor in all those different investment dates and amounts. So let me repeat, because this is so important. For a lump sum investment, look at CAGR. For your SIPs, you must always, always look at your XIR.
You're going to see ads all the time that boast about a massive absolute return, or ARR. They'll say something like, "We turned one lock into two locks. That's 100% absolute return. Sounds incredible, right?" But it's almost meaningless if you don't know how long it took. If it took 10 years to double that money, your actual yearly return, your CAGR, is only about 7%. So whenever you see an ARR number, the very next question out of your mouth should be, over how much time?
You know, high returns are great, but they often come with a hidden passenger, risk. You wouldn't buy a car without checking its safety rating first, would you? Of course not. And that's exactly what our fourth bucket is all about, the quality check. These are the numbers that let us pop open the hood and see if an investment is a smooth, reliable ride, or if it's a breakdown just waiting to happen.
One of the best ways to measure risk is with something called beta. Just think of it as a volatility score. Now, the overall market, let's say the Nifty 50, has a beta of exactly 1. If a fund or a stock has a beta more than 1, it means it's more volatile. It's going to swing up and down way more than the market. If its beta is less than 1, it's more stable and safer. So if you're nearing retirement, you probably want a low beta. If you're young and can handle the bumps in the road, maybe a higher beta is okay for you.
Okay, let's do a quick fire round on a few other critical quality checks. First, the Sharpe ratio. This answers a simple question. Am I getting paid enough for the amount of risk I'm taking? A higher Sharpe ratio is always better. It means you're getting great returns for the volatility you're putting up with. Next up, the PE ratio, or price to earnings. This basically tells you how expensive a stock is compared to the profits it makes. And finally, and this one is so important for mutual funds, we have TER, the total expense ratio. This is the fee the fund company charges you every single year. It's like a silent leak in your tire, slowly draining your returns. Your job is to find funds with the lowest TER you possibly can.
Now let's bring it back from the market and the funds and focus on the most important person here, you. Our fifth bucket is all about your personal financial health score. These are the metrics that help you answer that critical question. Can I actually afford this?
And the single most important health score is your DTI, or debt-to-income ratio. The calculation is super simple. You just add up all your EMIs. That's your equated monthly installments for your home loan, car loan, everything. And you divide that total by your gross monthly income. This gives you a percentage that shows exactly how much of your salary is already gone to pay off debt before you've even bought groceries.
So what's a good score? Well, the golden rule of thumb is to keep your DTI below 40%, and really, you should aim for closer to 30%. If your DTI is higher than that, it's a huge red flag that you might be stretched too thin. Banks look at this very carefully when you apply for new loans. They also check your CCR, or credit card utilization ratio, basically how much of your credit limit you're using. Keeping that below 30% is another great sign of financial fitness.
And that brings us to our final bucket. After you've done all the hard work, you've saved, you've invested, you've taken risks, and you've earned a profit, there's one last person you have to deal with, the tax man.
Understanding the basics of tax is absolutely non-negotiable for any investor in India. Okay, so when you sell an investment and make a profit, that profit is called a capital gain. How the government taxes that gain all comes down to one simple thing. How long did you hold the investment? STCG stands for short-term capital gains. That's the tax you pay on profits from things like stocks or equity funds if you held them for less than 1 year. LTCG is long-term capital gains, and that's the tax on the same things if you held them for more than 1 year. Generally, the tax rate for LTCG is lower because the government wants to encourage you to think and invest for the long term.
Whew, we have covered a ton of ground. So to make this all super practical, here it is, your cheat sheet. This simple table connects common financial situations with the exact acronyms you need to be looking at. Planning for retirement? You need to know about SWP and MPS. Just checking up on how your SIP is doing? Focus on the XIRR and the fund's Sharpe ratio. Thinking about getting a loan? Calculate your DTI first. And choosing a new mutual fund? The first thing you check is its TER. Seriously, I want you to take out your phone and take a screenshot of this slide right now. Save it. Keep it with you. Because the next time you're in a bank or talking to an advisor, you'll have the code right there in your pocket. You now speak the language. The only question left is, what are you going to do with this new power?